As the Bitcoin markets evolve, the number of ways in which you can trade it does too. Now, I'm sure you all know about the numerous futures markets out there, but did you know that Bitcoin options are being offered on an increasing scale? And that these instruments can open up a whole range of trading strategies you didn't know about. Now that I have your attention, allow me to introduce myself. My name is Guy, and in this video I'll be going over what exactly Bitcoin options are, how you can use them to protect your portfolio, where they're currently being offered, and my personal view on where the options market is headed. So be sure to stick around if you want my personal take. Now, just a few words before I get underway. I do these videos for educational purposes only. They should not be considered investment advice in any way, shape or form. And also, if you're new to the channel, a pleasure to make your acquaintance. In order to keep up to date, why don't you hit up that subscribe button and tap that bell while you're down there? I release these videos regularly, so you don't want to miss them. Okay, all set? Onwards with options. Now, before I can take you through any sort of option trading strategies, I have to lay the groundwork. So, what exactly are options? Well, their name says a lot of it. They confer on a holder the right but not the obligation to buy or sell an asset at some time in the future. When you enter a call option, it's the right to buy, and when you enter a put, it is the right to sell. They differ from futures instruments in that futures have an obligation to buy or sell the asset that you've entered a trade for. So, basically, with an option, if you find that exercising the right to buy or sell is not profitable on expiry, you can let it expire worthless. With a future, you have to either cash settle it or buy/sell it. So, this means that options are instruments with asymmetric payoffs. What do I mean by that? Well, look at this graph of a simple call option. And now, look at the graph of the futures instrument. Notice anything? Well, you can see that your loss on this trade is limited only by the option premium or cost of the option. You can't lose more than you've already paid. With the future, on the other hand, your potential loss is unlimited. Or take a look at this graph of a put option. And now overlaid with a short futures contract. Same thing on the downside. If the price of Bitcoin rallies, you have a maximum loss with the put option, whereas you have an unlimited loss on the short future. Of course, this is more applicable to the listed and OTC future varieties. Leveraged futures trading exchanges will be quick to liquidate you to prevent negative equity, and hence limit your downside. There's also another side of this option crypto coin. You can also sell options. This, of course, limits upside and could lead to unlimited losses. Why would anyone sell these, you ask? Well, they can form some pretty unique trading strategies with them, something that I'll cover in a bit. Before I get onto that though, I need to cover some option theory. So let's dive into the deep end and be sure to pay attention so as not to drown in maths. When it comes to options, there are a number of variables or inputs that impact on its value. These are the strike price, the spot price, the time to maturity, the underlying implied Bitcoin volatility, and the risk-free rate. The strike price is the price at which you agree to buy or sell the option in the future. The spot price is the price right now. Time to maturity is how long the option has to go, and implied volatility is a measure of how risky the market is. Each of these factors impact on the value of the option in their own unique way. The difference between the strike and the spot has perhaps the most direct impact on value. However, holding other factors equal, the higher the volatility, the more valuable. The longer the time to maturity, the more valuable. Anyways, these variables or inputs are often labelled the Greeks. No, not that one. No, come on now. Yes, those ones. Theta, sigma, rho, delta, etc. The exact mechanics and maths behind these inputs can be quite complicated, so I won't go into them here. However, check out the description where I've linked to my in-depth overview. There is one more thing that I briefly need to discuss, and that is the moneyness of an option. It's that relationship between the spot and the strike price which has the biggest impact on the option's value. Simply put, an option could be in the money, at the money, or out of the money. Here are what they mean. In the money is when the spot is above the strike for a call option, or if the spot is below the strike for a put option. Out of the money is when the spot is below the strike for a call option and vice versa for a put. At the money means the strike equals the spot price. I should also point out that these all assume the pricing of plain vanilla European options. You also have way more exotic variants that I won't be covering today. Still with me so far? Great. So you now have a vague understanding of options, but I'm not here to bang on about theory. Let's dive into the real meat of the video, option strategies. Given that options have an asymmetric payoff, you can structure some pretty unique strategies with interesting payoff profiles. For example, assume that you're pretty bullish on Bitcoin in the short term and would like to go long. However, you don't think that it will really moon beyond 14K by the end of the quarter. So instead of buying a simple call option, you could buy a call option and finance part of that cost by selling a call option with a higher strike price. This is called a bull spread and has both an upside payout and a downside loss. The difference between this and a simple call option is that you have a lower downside loss. And this bull spread can be done for a downside bearish trade as well. Here is a bear spread where a short put option decreases the cost of the short. Or how about if you don't really know where Bitcoin is likely to go, but you are certain that it will be incredibly volatile in the next quarter? It could moon, or it could tank. You could then buy both a call and a put at the same strike price. Here you have what is called a straddle, and if the price moves dramatically either way, you get a decent payout. Of course, buying two at-the-money options could be costly, so you could buy a call and a put that are both slightly out of the money. What you have now is a strangle, and this is your payout. Or how about you sell away the upside on both options with two more options? You now have what is called an iron butterfly, and it guarantees you a certain payout if Bitcoin rallies or tanks. It can also be called an iron condor when done on a strangle. Yes, I know, some pretty creative names. What about if you perhaps have the view that Bitcoin won't move anywhere for a couple of months? Well, then you can also sell, straddle or strangle. Your play here is that volatility remains low. You can also limit your downside by buying another call and a put. These are only a few of the strategies and spreads that you can design. You can also build something called calendar spreads, which structure options with different expiry times. If you wanted more spreads to play with, I've linked to a handy payoff calculator below. Now, I'm sure that you're wondering where you can buy these options, so let's take a look into that now. When it comes to the market for Bitcoin options, they are far less developed than the futures markets. However, there are a number of places in which they're offered. There are three types of market where Bitcoin options exist. Through swap and option dealers like LedgerX, listed on an exchange such as the CME or Bakkt, on retail exchanges such as Deribit. For traders like you and me, perhaps our best place for us to buy these options is on Deribit. This is a crypto derivative platform that has been around since 2016. It's quite popular and also offers perpetual and quarterly futures contracts. But we don't care about that. We're interested in their options instruments. They currently have two markets for options, Bitcoin and Ethereum. I'd rather opt for the Bitcoin options as these have the most liquidity. This option exchange works much the same way as traditional exchange order books, except that there are numerous markets. The markets will differ according to whether it's a call or put, the expiry as well as the strike. You can bid or offer options in order to build your required strategies. Let's build a strategy right now, just to give you an idea of how it would work on the platform. Now, what strategy should we build? Tell you what, I'm bullish on Bitcoin in the next 3 months, but don't think that it will rally much above 12K. So I'll build a bull spread. A simple bull spread requires 2 call options, one long and one short. I'm going long a call option on 10 Bitcoin with a strike of $10,000. This is slightly out of the money when we were recording this. As you can see from this order form, it implies a price of about 0.081 Bitcoin per option or 0.81 Bitcoin for the 10 Bitcoin. With these options, if Bitcoin is below 10K at the end of March, I will have a loss of the 0.81 Bitcoin I put up. Still a pretty hefty sum. However, I can reduce that potential loss by selling away a bit of the upside with a short call option at $12,000. Both of these options have an expiry in 3 months, which is the time frame for my trade. Once orders are placed and executed, my trade is live. Now, there is something to point out here. The options on Deribit are marked to market constantly, so your bull spread P&L will constantly be adjusted to reflect it. You'll also have to put up a sizable margin for the short position as well. This is just so that Deribit can manage the risk posed by short options in general. On expiry of the trade, your bull spread should have the same payoff as you pictured in our payoff diagram. Setting up any of the other strategies works in the same way. Be sure to match the expiry and then you can choose the strikes that are needed for said strategy. Oh, and one more quick point. For strike prices that are far away from the money, you may struggle with liquidity. This is just a factor of it still being a relatively new market. Now, if any of that was unclear to you, don't worry. We have a complete review of Deribit that I've linked to below. Let's switch gears now, as I want to talk about the broader potential for crypto options. One of the biggest markets for crypto options has to be from institutional investors and miners. The latter to finance operations and the former to protect or enhance crypto portfolios. Previously, large option contracts used to only be traded over the counter or through swap dealers. Dealers such as LedgerX structured bespoke option deals that saw some hedge fund traders make millions. Like the example of this guy who bought Bitcoin options for $1 million in December of 2017. These options had a strike price of $50,000 and an expiry date at the end of 2018. The bet didn't work out too well for him, but at least he didn't put his on the line like John McAfee. Anyways, the problem with these OTC option contracts is that sometimes the dealer can't find a counterpart to their trade. The OTC market is chunky and idiosyncratic. This is where exchange-listed option contracts have an advantage. These markets are more liquid as the contracts are standardized. Hence, it's a lot easier for institutions to structure trades. Bitcoin options are now being offered in listed form on a few exchanges. In December of last year, trading began on quarterly Bitcoin options on Bakkt. For those who don't know, Bakkt was the first regulated futures exchange to offer physically settled Bitcoin futures. Not one to be left behind, in January of 2020, the CME announced the launch of their own listed Bitcoin options contracts. There was a lot of anticipation for the launch of these options as open interest in the CME futures market spiked just before the rollout. On the first day of live trading, volume on the CME exchange exceeded all the volume that was traded on Bakkt since its launch last year. What's driving the demand? Well, I think it's a number of things. Firstly, given that these options settle into CME Bitcoin futures, traders have another unique way to profit from the future settlement dates. They can structure option trades around these highly volatile dates. You also have the upcoming Bitcoin halving and the potential volatility this could throw up in the Bitcoin markets. Oh, and if you want my take on the halving, then I completed a comprehensive overview which you can watch right here. While it is only Bitcoin options right now, I think we could also see Ethereum listed contracts in the not too distant future. This is because it seems as if listed ETH futures are about to hit the market. Given that Bitcoin options followed the Bitcoin futures, it is not beyond the realm of reason to expect the same from Ethereum. Anyways, what could all these options mean for the Bitcoin markets? Well, I think that options are less of a speculative instrument than futures are. They're a great way to hedge risk in an inherently volatile market such as Bitcoin's. By reducing risk, it could temper volatility. There is strong evidence that the introduction of option instruments to the FX markets had a calming effect and brought down the wild swings that it used to have in the past. As we know, one of the primary arguments made against Bitcoin is that it's too volatile to be used as a medium of exchange. If more stability is brought to the market, could we see more adoption of Bitcoin or crypto from the reduced volatility? Food for thought. I'm also hoping to see more retail exchanges offering crypto options which can be used by most of us. Although they're slightly more complicated than futures, they give us a more sophisticated and less risky way to trade the markets. They're also more of a risk management tool than a form of speculation. If you take a look around crypto trading circles these days, it appears to mostly be centered around multiplying an investment rather than preserving a portfolio. Another thing that we're likely to see pretty soon is decentralized options built with smart contract technology. Already there are a number of projects that are building blockchain-based solutions for derivative instruments. So, in other words, we could one day see decentralized option exchanges. Think 0x or Kyber, but for bespoke option contracts. You heard it here first. DeFi option contracts built on the blockchain and traded on-chain. Immutable, transparent, and in your hands. We've been through a lot, so congrats if you're still with me. I'm going to wrap this up now with a few of my final thoughts. I'm really quite excited about the opportunity presented by Bitcoin options. Firstly, it's going to further credentialize Bitcoin markets in the eyes of the institutions. With a regulated and liquid options market, these big funds are more likely to dip their toes in. It could also provide an important risk management tool not only for these funds but also for those businesses that rely on Bitcoin. Miners could write contracts to hedge Bitcoin risk for future mined Bitcoins. By providing certainty of cash flows, it could encourage more capital investment today. As these options bring more certainty and security to the Bitcoin markets, it could quell some of that intense volatility. A more stable Bitcoin is a better outcome for all. No longer will you have to hear the argument that Bitcoin is too volatile as a currency. Moreover, if Bitcoin options turn out to be a success, then it could open up the possibilities of numerous other cryptocurrency options. Bull spread on Stellar, anyone? How about a strangle on Tron? And as mentioned earlier, there are a whole host of more exotic option types that exist in the financial markets. If vanilla options on Bitcoin turn out to be a success, we could see more exotic variants eventually being launched. Could we see American options? How about the Asian kind? Or maybe the digital variant? Barrier options, anyone? Basket options? This ain't all mumbo jumbo. These are advanced options with unique payoff parameters. They're regularly priced in traditional financial markets and they provide their own unique benefits. Indeed, there may be an OTC broker right now that's already facilitating deals of more exotic cryptocurrency options. If there's one thing that we've learned, it's that dealers will line up to provide markets as long as there is demand. Either way, I'm really excited about the future of the Bitcoin market. Liquidity is increasing and efficiency is on the rise. Volatility is decreasing and ignorance is on the decline. And that, my fellow crypto traders, is my video on Bitcoin options. But now the moment of truth. What are your guys' thoughts on crypto options? Do you have any questions for me? Let me know below. Also, if this overview was helpful, then help support this channel. Give me a thumbs up and don't forget to subscribe. It's much appreciated.